Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Discover Financial Services, ticker DFS. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up is market cap of $26 billion, enterprise value of $32 billion. This means you have about $6 billion in net debt on this business. I was going to apply some leverage to their returns. It is in the consumer finance industry. So let's look at the business description. Discover Financial Services provides digital banking products and services and payment services in the United States. It operates two segments, digital banking and payment services. Digital banking offers Discover branded credit cards to individuals, and payment services operates the Pulse ATM machine debit and electronic funds network, Diners Club International, and a payments network that issues Diners Club branded cards. So this is a really interesting business that I have actually owned in the past, so it's not a true first look, but I haven't done an analysis using QuickFS on this business. I don't currently own this stock, but I have owned it in the past, so take that for what you will. Now, beta of 1.47, this means it's going to be a little bit more volatile than the average S&P 500 company, which tends to mean a sign of a lower quality business, but I don't believe that's going to be true, which you will immediately see with their return on equity numbers. First thing you know, if you're a long-time user of this channel, is that I like to see 20 straight years of profitability, and that is exactly what we have with this business. Is you have every year that they have been operating here from data is all profitable. Not only that, when you look at their history since 2005, the lowest return on equity that they have had is 10%. They had 10% in 2007, 10% in 2010, 10% in 2020. So basically during recessions, their return on equity drops to 20 to 10%, but during better operating times, they're running returns on equity of 20 to 30%. Look, 25% in 2005 at the peak, 17% in 2009, 30% in 2011. You got up to 25% in 2019, and the most recent year was 44%. Now, you can clearly see the most recent year is an outlier here, but think about these numbers. You're ranging from 30% to 18% as a low in 2017. Really, really good numbers running in 20% for return on equity. When you have a high return on equity like that and you combine it with growth, you can get really strong returns, really good performance for you as an investor. Let's take a moment to look at some of the key statistics. They have a return on assets of 2.7%, return on equity of 22%, 22.6%. You need to think about this. One, this is a company that is a bank. So banking businesses should be judged in two methods. You have return on assets and return on equity, but it's really return on assets plus leverage. And so one of the ways that I like to think about it is that, your average bank is going to have a return on equity 10 times the return on assets. So if you need a 10% return on equity, you need a 1% return on assets. If you want a 20% return on equity, then you need like a 2% return on assets. Something like 2.7% is world-class in terms of banking performance. This is actually extremely high, and part of that is due, I believe, to the payment services part of this business, providing some non-interest income that's allowing them to boost their return on assets. But regardless, this number is extremely impressive. Now, it's not leading to a pure 10x, but that means that they're running probably at a slightly lower leverage level due to the fact that they're operating in the credit card business, which is a little riskier. But overall, really impressive 10-year median returns. Also, because of the credit card industry that they're operating in, this NIM number, which is your net interest margin, is 8.2%. This is extremely high. You might have successful banks that are running net interest margins in the 2 or 3% range and be very, very successful and have very good return on assets. Discover is operating with a much higher net interest margin because they're able to charge such high interest rates on their credit card loans. So something to think about it, but these numbers indicate a world-class, high-quality banking operation, and was one of the reasons why I bought this company in the past. Now, as we look at it today, the valuation looks really, really good. We have a PE of 6, price to book of 2. Again, it's worth paying a price to book of 2 here because the return on assets are so amazing. A lot of people will buy banks on price to book value, but I think that's a mistake. You should buy banks on earnings. And what we see on earnings here is a PE of 6 tells the better story, and it shows that even though it's basically justifying that you can pay above book with the bank like this because the assets are so high quality and the earnings are so high quality here. Now, the other thing that you're going to see when you look at a business like this is your return on equity compared to the 10-year CAGRs in growth. You're growing your interest income at 7%, loans at 5%, assets at 5%, deposits at 6%. The two things you want to think about here is really deposits versus earning assets, which is basically going to be very similar to deposits versus loans. So your 5%, your 6%, this is kind of the growth rate that you expect for this business then. You're growing 5-6%. Okay. But what that means is because your return on equity is 22%, you're only going to need less than half of your money to go towards actually growing the business because your return on equity is so much higher than this requirement. And that means that you're going to be able to leverage their return on equity to a very high degree, and you're going to be able to grow at this rate while paying out a lot in dividends or buybacks. And that should be what we see here. So let's look a little bit deeper into the numbers. You can see that this net interest margin is not a one-off. You're consistently at that 8% level. Again, that's a very attractive number. And also because it's a credit card business, they're able to really control for net interest margin. This is a good sign for a high quality business. You can see how what I was talking about assets to equity, they're not spending most of their time leveraged 10-1. You have a lot of time spent in the 7 range, some time spent in the 8 range, like here at the 8. So you don't necessarily have that 10-1 leverage return on assets to return on equity. One thing you want to touch on here, though, is look at this earnings per share. You started the decade at $4.46. You end the decade at $17. Now, that's an amazing return. You 4x'd in 10 years. Basically equivalent to doubling your money every 5 years. If you were to do that, you're talking about something like a 15% annualized return on investment. That's a very attractive number to be hitting. However, it is a bit of an outlier in 2021, and I think this is going to be upset a little bit with some of the one-time adjustments from 2020 and 2021. I think that's why there's a decline here. So you can understand that some of this is some adjustments on a different level. But something that is a lot more stable is dividends per share. And this is a better reflection of what the company would see as a stable part of the business. And you can see they've gone from 40 cents per share to $1.88 per share. So that's still reflecting a 4x over the course of a decade. Very, very attractive when you can grow at that rate. Now, is their sustainable rate that high? It doesn't look like it. The 10-year CAGR is showing it to be, in the high single digits. So I would expect something in that 10 to 15% range in terms of potential returns as an investor. But you always have this upper end that's available if they can grow their assets closer to your return on equity. You can be very, very attractive. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe. Ring that bell so you can get notified as I upload new videos each and every week, Monday, Wednesday, Friday. And at the end of this video, we will have a link to the playlist where I've covered all of the S&P 500 companies so far. Income statement. Let's take a quick look. You can see that the provision for credit losses is a really big part of the differences in income here, right? So you see this net income, $5.4 billion in 2021. And $1.1 billion in 2020. But the actual interest income is very similar. The actual net interest income is very similar. And the big difference is provision for credit losses. So in 2020, they expected massive losses from COVID. That didn't happen. And so then they gave those, then you had much less in 2021 because they'd already over-reserved. And this difference in reserving is what's causing the volatility in earnings. Their business is not nearly as volatile on earnings as it looks because this net interest income after provision is really what you're going for. You can see that this is stably growing steadily each and every year. Very strong business here. And so it's going, well, I mean, probably net interest income is the one to look at here, minus the difference here between non-interest expense and such. So for a business, certainly credit losses are important and these provisions are important, but it's making the numbers look more volatile than they are. This is actually a very, very high quality business. And one of the things that you see with this is when you look down to the shares diluted line, you can see you've gone from 520 million shares outstanding to 300 million shares outstanding. They've retired about 40% of their shares outstanding over the course of a decade. That's very, very impressive. You think about that's adding about somewhere between 3 to 4% extra per year to your returns than you would have otherwise. So you're getting your shares getting bought back, you're getting a dividend that's growing, and you're getting a current earnings yield of around this 6% where you're growing. So you're getting all of this adding up together where you're going to say, okay, I have 6% growth here, I have 4% returns from my share buybacks, and maybe I have an additional 1 to 2% returns from my dividends. It's called 2%. So that's targeting like a 12% annualized return for Discover Financial Services if they continue to keep up this rate. Go to the balance sheet. It's hard with banks to really take a big understanding of the balance sheet, but one of the things that you can see clearly is they're consistently running gross loans higher than their deposits. And so they're using some long-term debt leverage to get that boost. This is a big part of what's going on in terms of them leveraging the business model. So you should be aware of that. It is high. They're running a high loans to deposit ratio, but it is allowing them to get their returns, and they've done it quite successfully. Cash flow. Cash flow is not very useful here for, again, the bank, the way that it's presented on this website. The main takeaway I have here is you see stock-based compensation kind of ended in 2015. That's really good to see. I don't like seeing stock-based compensation. And then you can see the slow and steady continuous stock buybacks, slow and steady growth of dividends. Very good sign here for getting that cash return to shareholders. They're spending a significant amount of their cash flow to return it to shareholders, and that's really good for you in terms of your total returns. So everything I see here is really attractive. Discover Financial Services is absolutely going on my watch list. I have owned it in the past. I don't own it in my portfolio today. Mainly an issue of just I've found some better opportunities in smaller stocks, and I wanted to own a different bank. So when I sold Discover, I sold it to buy a different bank. I currently own that other bank still. But otherwise, in terms of large cap stocks, in terms of S&P 500 stocks, Discover Financial Services has got to be one of the best things that I have seen in this analysis. Thank you for listening, and until next time, stop paying fees, start building wealth. Don't forget to like, subscribe, and if you want to check out quickfs.net, this is the software I use for my investment analysis. The first link in the description below is my affiliate link. Consider using that affiliate link to sign up, and then I will get a commission for going over there. So if you want to support the channel, please sign up for quickfs.net. Free or paid account would be a great way to support the channel. Thank you for listening.